announcement. Okay, so for next week, you should start reading chapter 5 of the Zhongsha and Xin book. So I hopefully will have enough time to finish financial markets today. And then there will be the midterm. And you gotta check now. It's in week 5. So that's not next week. And it will be on the Wednesday. Today's Wednesday, right? So it will be right here. Okay, so from 2 to 3, it will be 50 minutes. Yeah, we'll tell you more later. I will put a old midterm online. So, yeah. So it's going to be a closed book. You don't have to bring your textbook or anything. That's the only thing you have to bring. It's really raining. But I will make more announcements next week. And relevant is everything. Everything is relevant to whatever we get to on the lecture on the Monday before the Wednesday. Okay, so this will be basically, if I don't get sick or anything, will be everything up to chapter 3. Okay, so basically chapter 3, 4, 5. Right? Cool. Okay. Let's see if we can finish financial markets today. Let's briefly jump back to last Wednesday. So how far did we get? Well, we got so far that we have derived this money demand function. And money demand was a function of nominal output times some term. I mean, this L usually stands for liquidity, even though I didn't really say it. It's determined by the level of transactions, because you need money to do these transactions. At least in this very simple version here, it is proportional, the money demand to this, and it's a negative function of the interest rate. Okay, so if the interest rate goes up, the money demand goes down. And this is shown here as this downwardly sloping curve. Okay, so the interest rate is low, demand is high, interest rate is high, demand is low. And so already said, money demand is proportional to the level of transactions, which is here assumed that every transaction in this economy is somehow done by using money. So if this goes up, of course, so if nominal output goes up, or the volume of transactions in the economy increases, you need more money. So the demand for money will go up. And you see that if we draw this, here we have M, okay? The money demand, the money supply on this axis. On this axis, we have the interest rate. So for this picture, this is like an exogenous variable. Okay? So we can ask what happens if nominal output goes up. So that's a shift of this curve. Okay? So endogenous is M and the interest rate in this model. Okay, so we had this last week, and I started to talk about what the Reserve Bank is doing in Australia. Other central banks in the world are doing similar things. And the instrument that they're using is so-called domestic market operations. So they have a department that is actively involved in the market for bonds, for government bonds. So they're selling and buying bonds, okay, to other actors on the market. Could be private people, could be other private banks. It doesn't matter. But what happens if the bank is buying bonds, it has to pay for it somehow. And it's doing it by using, basically, putting money in circulation. Okay, so they have the monopoly, the Reserve Bank in Australia, other central banks, the monopoly for the currency, for the legal tender in this economy. So if the Reserve Bank would conduct an open market operation, so if they would say buy bonds, they would just buy with Australian dollars. And they come out of their account somewhere in Sydney and or electronically. They will not physically move between banks or so. So electronically, they will, the money would show up at whoever's buying these bonds or selling these bonds to the Reserve Bank on their account. Okay. So how it is done in concrete? Okay. So again, quickly, the central bank doesn't really. It has a target in Australia and for other countries. The federal funds rate target in the United States is between 0 and nothing really percent. So they basically have a tunnel where they want to stay in. In Australia, they have and this tunnel in the United States is more because it kind of went down to 0 and they didn't want to keep it at 0. So they have some tunnel here where they want to keep the federal funds rate in. The Reserve Bank in Australia has a target that is not a tunnel, it's an exact number. Okay, so it could be 425 basis points or something. That's what it's at the moment, and that's what they said. Okay, so here's just because it's not in the textbook, the cash rate target and the cash rate. I'll just look at the red line, which is the cash rate. It's the actual cash rate in Australia from 1976, I think, April 76, all the way to today. Okay, so there's quite some fluctuations. There was a lot of fluctuations before this. The Reserve Bank said that's our instrument. So only up to January 1990 did they actually target the cash rate. Before they used other means of monetary policy. Only then did they target this rate. Okay, and the effect you see here. So there was quite some volatility of this rate before 1990, but then they tried to target this rate. Okay, so basically they met once a month and decided to keep the rate where it was or change it. Okay, so they met last week and they decided not to change. Okay, but it could be could be different decision they make next month, if you will. So basically they do not allow these large fluctuations anymore. Okay, so they're active on the market using open market operations to influence these rates. And of course, these rates are not unconnected to all the other interest rates that are floating around in the economy. Okay, so here I just have a list of other particular treasury notes and interbank interest rates. They all basically move in the same direction as the cash rate, which is the red line. Okay, so the central bank is only targeting one rate, that's the cash rate. But the vector of all the other interest rates in the economy is moving basically where the central bank wants to see these interest rates, and it's because it's influencing the conditions for the private banks, the financial conditions for the private banks, and so they derive then all the other interest rates from this. Okay, let's talk about open market operations. Okay. So as I said, the cash rate is the rate that is the interest rate that private banks have to pay for overnight loans. Okay, so at the end of the day, some banks have some reserves left. They don't know what to do with it. Other banks maybe need some reserves because they want to hold some reserves at the RBA in Australia, or they have to transfer some of the reserves wire the RBA to another bank, so they maybe need some funds. So there's a market basically in the end of every business day, and the market that market determines an interest rate, and that's the cash rate. Okay, so the central bank in Australia does not determine that. It has a target, but this rate could be basically any number on a given day. But what the central bank is doing in Australia, it kind of influences the funds available for the private banks. Okay, so if they see that the cash rate is increasing, they will basically work against this. So if the cash rate is increasing, that means that the private sector or the private banking sector doesn't have enough funds. Okay, so if they see that the cash rate is becoming or is deviating from the target that they have set, they will not, for a couple of minutes, say, or whatever, will allow this. But once they observe this, they will be active on the market. So what they will do, they will make funds available for these banks. So if more funds are available for the whole banking sector, of course the demand for funds from one bank to another on this market will be reduced. Same way, if the interest rate is lower than the target, then you see there's all of a sudden too much of these funds around. So they would sift out some of the funds. And how do they do this? Well, they do this via open market operations. That is, they buy and sell bonds, government bonds, from private owners of these bonds. So think about private banks. Okay. So how does it go? How does the central bank do this? All of us 10 minutes. So let's jump to page 23, which is where we ended last week. Well, we didn't discuss that yet. Okay, so what I have here is the balance sheet of the central bank. Okay, it could be the Reserve Bank of Australia, it could be the European central bank, any central bank that you could think. Okay, so this central bank has a balance sheet, and where we have assets and liabilities. And the assets the central bank has here in this very simple model. Theoretically, they could have other assets, but usually they only trade in these. Are bonds. Okay, so from the past, they bought a couple of bonds. But how did they buy these bonds? Well, they bought these bonds in the past, of course, by issuing money. Okay, so they have the power to, if they want to buy something, they just print more money, essentially. So the money that they have printed, it's the liabilities of these banks. Okay, so they issue money and buy bonds. And of course, if they have bonds here that are worth $1 million, then they must have paid for them using $1 billion. Let's say billion, $1 million, and they must have paid for them with $1 million. So the money in circulation, so the liabilities of the central bank would be then $1 million. Okay, so that's where we initially are from, but I basically already told you the story. So what happens now if there's what we call an expansionary open market operation? Okay. Why do we call it an expansionary open market operation? So what happens here? So there's an open market operation, and the central bank becomes active on the bonds market. What do? They buy bonds. Here, as in the example, say $1 million of bonds. Okay? So their assets go up by $1 million. Of course, they have to pay for it. Nobody gives them these bonds for nothing. And they pay for them by using their currency, Australian dollars. Okay? So most likely they will not have a pile of money and just give it to somebody. in $1 billion. So it's just other private bank. They will, this will show up on the account that this bank has with the Reserve Bank. But anyway, so this money is then of course available for the private bank. Okay. And why do we call it an expansionary open market operation? It's because the money, the currency here in this economy is going up. It's expanding. Okay. So when the central bank buys bonds, more money is in circulation. Okay, so an expansionary open market operation is one where they buy bonds and the money in circulation is increasing. Okay. And of course they could do the opposite, right? Jump one slide, 25. They could be contractionary. So sometimes, as I already said, the bank maybe wants to suck out money out of the system, right? So what would they do then? Well, in terms of this, the T account that we have, what happens if they have a contractionary open market operation? Okay, so let's have the T account here again. So we have assets and liabilities, and that's the central bank here. In this case. So what happens now? So now the bank sells bonds, say in the value of $1 million. Okay, so what happens? So if they sell the bonds, the assets that they have, they go down by $1 million. Okay. Oh, sorry. What did I write here? Is this wrong? Okay. So if they sell bonds, if they sell bonds, these bonds disappear here. And of course, the private people have to pay for it. So if a private bank buys these bonds, how much money do they have to spend? Well, of course, $1 million. So this money that's in circulation in the economy ends up where? It goes back here. Okay? So the liabilities, the money that's in circulation goes down. By $1 million. Okay? So it's then at the bank again. So it's no longer a liability to the system. Okay? So if the central bank is selling bonds, the bonds go out of the central bank account and money comes in. So the money in circulation goes down. Okay? So the currency, the money, goes down. Okay. So far we talked about what happens to basically to the bonds, and we didn't talk about the interest rate yet. But of course, there's a connection between what the central bank is doing in an open market operation and the interest rate. So I give you here a very simple example of an interest rate or of a bond that promises to pay $100 by the end of this period. Let's suppose this bond is issued on the 1st of January, and the promise the government gives you is by the last day of the year, within 1 year, say, they will give you $100. Okay, so the only fixed thing is the amount that you get paid back. If you give, if you buy a bond, you essentially give a loan to the government, the amount that you get. Okay, we could put a different number here. I just use a simple number, or simple for me, say $100. Okay. But the issue, of course, is how much is this worth for anybody here who would buy these bonds? Okay, so on the first day when this bond is issued, say on the 1st of January, there will be a market for these bonds. So there will be supply of bonds by the government. They want to get funds, so they issue bonds to finance projects, and there will be demand for it. So some people will maybe hold them for a while and get promised to get $100 after 365 days. So there's a market, so there's supply and demand. And what happens? Well, there's going to be a price. And let's call this price of this bond, the price that this bond is traded, as PB. Okay, so that's a nominal price here. So it's in dollars, so that's why I have this dollar. Right, so there's this price of this bond, and that's your investment. Okay, so if you buy these bonds, or one of them, on the 1st of January, that's the amount you're spending, and that's what you get. So having these two pieces of information, we can derive the return, the interest rate you get from your investment. You invest in these bonds, you invest PB, could be $90, say. What's your investment worth then? Well, you can compute the interest rate out of this, because your investment is PB, and the return that you get is the difference of what you buy bond for and what you get back by the end of the year. So if you assume that this price is, say, $90, right? My interest that I would have, or I would obtain here, is 100 minus 90 divided by 90, which would be 10 divided by 90, which is probably around 11%. Right? Okay, so I invest $90 and I make $10. Okay, so my return would be about 11% in this case. Okay, so 10 divided by 90 is around 11. I hope. Think. Okay. So of course this price of 90, say, or any other price, and the interest rate are connected. And I can just like rewrite this thing here as this. Okay, so if you don't know how I get there, what have I done here? So I have the interest rate is 100 minus PB over this. Okay, so then I have, what do I have? I have 100 over the price of the bond minus 1. Okay. Then I bring the 1 to the other side, so that 1 plus I equals 100 over the price of the bond. Right, and then I bring the price of the bond up here and the interest rate down there. Then I have the price of the bond is negatively related to the interest rate. Okay, which is clear. If the price of the bond goes up from, say, $90 to $95, what happens? So if the price goes up, to $95, what happens? So the price on the bond market goes up. What happens to the interest rate? Well, The interest rate, of course, was still $95, given by this formula. So I have $5 divided by my investment of $95. And I'm not good at math, but it's less than 11%. 0.6%, right? Okay, so if the price of these bonds goes up, the interest rate goes down. Okay, so if you hear in the news that the bond market went up, it means that actually the interest rate is going down. Okay, so it's around 6%. Okay, but of course, if the how could this happen? How could the price go up? Well, if there's a fixed supply of bonds that the government, is trying to issue, how can the price go up from 90 to 95? Well, somehow the demand for bonds must go down. So, how can this happen? Well, somebody must have been active on this open market. Okay, so the interest rate goes down. So we must have had an expansionary open market operation. Okay, so the interest rate goes down, but the interest rate that the government in this case has to pay to get these bonds sold goes down, so the price goes up. Okay, so in terms of our little money market model here, what happens? Well, if you have an expansionary open market operation, the central bank buys bonds and uses or brings money in circulation. So what happens exactly this, there's more bonds in operation, in circulation, and the interest rate falls. Okay, so the bond price goes up, but the interest rate goes down. So that's the working of an expansionary open market operation. And of course, if this would be our initial equilibrium, it's point A prime, and we have a tractionary open market operation, so the RBA is selling bonds, more bonds, it would be harder for the central bank, for the government to issue these, because there's more circulation, so they have to pay a higher interest, otherwise people would not buy them, so the bond price goes down and the interest rate would go up. Okay? So if we have a contractionary open market operation, everything of course goes in the other direction. Okay, we have 20 minutes. I'd like to finish the chapter. Let me just see what I showed. Okay. Well, I already told you when the central bank does an open market operation, it usually sells and buys from commercial banks. Okay, and then basically, at least in the initial period, the additional money will show up as reserves at the private banks. So basically, the private banks have in their assets, on their asset side, the bonds that they have, the loans they give to all of us, and the reserves. So that's part of the central bank created money that doesn't sit around with us. Okay. So the central bank holds these reserves, the private banks hold they hold these reserves partially at some accounts at the directly at the central bank. Okay, so it's basically just some number in the accounts that they have with the central bank, or they keep some of the money there, central bank money they receive in their safes. Why would they do this? Well, you never know as a private bank how much money your customers want on a given day. So you always have some buffer in every ATM machine and etc. Okay, so these would be reserved. As long as they're not in circulation with that, this part of the central bank money would be reserves at commercial banks. Okay, I should write here. These are commercial. Okay, that's private banks. And talking about these reserves, so in some countries, for example in the United States, private or commercial banks are required to hold a certain percentage of the loans there, of the deposits that they have, as reserves. And that's essentially just some sort of insurance that was by law set up after the United States witnessed a lot of bank runs in the 1920s, and particularly in the early 1930s. Okay, so that's some insurance in the banking system. Nevertheless, even though, for example, in Australia there's no such law, at the moment also about 10%, but that's just a coincidence, but it's definitely a strictly positive number. About 10% is the reserve ratio, or that's part of the that's part of the deposits divided reserves that it's, private banks have as a fraction of deposits. It's about 10% as well, but it's simply voluntary by Australian banks. Okay, so by law they could use all the deposits that they have and give them out as loans, or don't even have cash in their at their branches, etc. Theoretically, they could do this, but of course they don't do that because every day there come customers and they want some of the money. Okay. So let's jump to page 35, and I'll tell you a little bit about how money comes in circulation and what is happening. So there's this similar multiplier effect. If money comes into the system, that mathematically similar to the multiplier effect that we looked at when we talked about the goods market. Okay? Of course, I didn't really tell you everything what's here. So but basically, this is a very simple model of the banking sector, which is a bit more realistic and what's going on in the banking sector. Okay, if you look again at our accounts here, what the central bank and the private banks have. So what happens? So if we are a private bank, where do we get our funds? Well, that's all of us putting some money into our accounts. Okay, so initially banks don't have any assets necessarily, right? So what they get is customers that put money into a current account at the private banks. And then the private bank can do three things. Well, they could buy bonds, keep some of this in forms of reserves, or it could give out loans to other customers. Okay? Could also buy houses and whatever, but that's not so important. Okay, so basically it can do three things with that. Okay. Okay, so we have derived this demand for money last week. Okay, so the demand for money is something like this. Okay, so we need so and so much money. But of course, not all transactions that we conduct use currency. Okay, so some dollar notes we use if we buy bread or other things, but for other things, like if we buy airline tickets, we probably just transfer money from our current account directly to the travel agent or to Qantas or whatever. Right? So some transactions are done with currency, and smaller ones, I would say, and bigger ones. You know, if you buy a car, most likely some people do, but you know, most of us would probably not buy a car. Depends how big the car is, of course. But we probably would use not currency to buy. So I have a very simple theory where this little c, which is between 0 and 1, gives us the fraction of the part of money they hold in currency. Okay, so I have a demand for money, so and so much. Some of it I hold in currency, and the other one in current account deposits at commercial banks. Okay, and this c, that's a c from the textbook. I probably would have used a different letter. It has nothing to do with the little c that we've seen when we talked about the consumption function. Okay, it's a different c, but it's also between 0 and 1. Okay, so if say c is a half, then half of the money demand, overall money demand, is held in front of currency, and the other half in the form of current account. And there's another parameter that we introduce here that gives us the fraction of how much reserves private banks hold as a fraction of the demand deposits that they have. Okay, so this was what we had a couple of slides ago, this 10.5% in Australia. Okay, so this data, is again between 0 and 1. Okay, so that's simply R, the reserves, divided by deposits. In some countries, like the United States, this is determined, largely determined by the central bank policy. They say they have to hold 10% of all deposits in forms of reserves at the central bank. Okay? In Australia, we see empirically, we get about, this thing is about 10%. Okay. So, how's then the demand for reserves related to the overall, the initial money demand in this economy? Well, it's first, from the initial demand, it's the fraction that ends up in deposit, and then the fraction of that one that's held as reserves. Okay, so this again are demand deposits, are the current account deposits, and this is the fraction. Okay, so these are then, that's how the reserve demand by banks is related to the overall money demand. Of course, since theta and C is between 0 and 1, we know that the product of these two numbers, which have to be between 0 and 1, is also between 0 and 1. Okay, almost done. Let's move this up. So now let's look what the demand for central bank money overall. Well, that's simply the currency and the reserves. Okay, so if we go back to our central bank T account here. So the central bank money is simply the sum of the reserves and the currency. And we have derived the demand for reserves and currency on the previous slide. Okay, so we have a demand here for currency and a demand here for reserves. So we simply have to just add them up. So we have C times the money demand, which is demand for currency, and we have a demand for reserves by banks. Okay, that's theta times 1 minus C times the money demand, which is this term. Okay. So we can simply pull this out, right, and then we have C. Okay. So that's demand for money, and that's simply what we had only last week. So it's a function of nominal GDP in the economy and the interest rate, and that's how overall demand for central bank money, which is simply the sum of reserves and currency, is related. So again, this thing is most likely this thing. How it is. This thing is less than that. For you to show, I'm not sure. Okay, so that's the demand, and there we have the supply. So if the money market is in equilibrium, okay, so if demand is equal to supply, we have a supply of central bank money and a demand for central bank money, which was this thing, right? And this was C plus theta 1 minus B. Where all these terms here are constants, so C and theta are constants. This is exogenous again, the level of GDP, and it's a negative function still of the interest rate. Okay? So that's just a little bit more of a general model of the banking sector. Okay, so it includes what private banks are doing here. But essentially, it's the same mechanism that we had before. Okay, so we have some supply of money and some demand. Just that we also have this intermediate step here in terms of the doings of the private banks. Okay. So when I talked about the federal funds rate, or the overnight market, i.e. the cash rate in Australia, it goes this market is concerning these reserves. Okay, so the demand, we have this here, is simply in equilibrium the supply of money, which we call H, minus a demand for currency. So what's then still left is the reserves. Okay, so if this, for whatever reason, stays constant, by increasing or decreasing the supply of central bank money, we can make more or less reserves available. So, just as a note, I mean, so the Reserve Bank only started in around 1990 to target the cash rate, and essentially can do things if you are a central bank. Okay, so if you have this money market, okay, so money supply and money demand, and here you have the interest rate. So you can do things. You can either say, I want to target the interest rate at, say, this level, call it I stop. But then, as a central bank, I have to react to changes in money demand. Okay, so there could be changes in money demand because, money demand is a function of output. And this could be also a function of other things there. So we don't really know how money demand looks like. Okay? So every central bank in the world has a couple of people doing all day long basically nothing else than trying to estimate the money demand function. Okay? Because it's most likely in reality a little bit more complicated than this little expression. Okay? So there's some uncertainty about it. But let's suppose this money demand goes up or down. Well, it would say it goes up. What happens? Well, the interest rate will go up. Okay. So, what does the central bank have to do? They have to increase money supply. In this case, if demand goes up, they have to increase the supply. That we end up at the same interest rate again. Okay? So what the central bank in Australia is doing is there are some changes in demand. So there's some changes in the cash rate. So what they do, they increase or decrease central bank money to keep the cash rate at their target. What most central banks did before 1990 was the opposite. They basically kept this one fixed, and they had a target for the money in circulation. So, for example, the Bundesbank always had these little pictures where they had time here, say 1975, and that was their money in circulation, on an M3 usually, and they had some area over time where they wanted to have the money in. Okay, so that's what they announced until 1976, say, and the money in circulation had to be in there. Okay, so they didn't really care if it's up here or down there, but they gave it some, flexible target, but not a target for the interest rate. They gave the target for the money in the economy. In terms of this picture, that would mean they're just they're only interested in how much money is in circulation. But if now the money's demand goes up or down, what happens? There will be changes, probably even dramatic changes to the interest rate. Okay, and when I showed you a while ago this picture, and that kind of gives you the result there. So, before the central bank was targeting an interest rate in Australia, the cash rate fluctuated quite a bit. Okay, so they were targeting the money supply, but since the demand went up or down, the interest rate, the cash rate, was pretty volatile. But the point is, as the central bank, you cannot target both things at the same time. So you have to make a decision. So you either can target the interest rate or the amount of money in circulation. Okay? What most central banks are doing today is they target the interest rate. Almost done. What's the time? 3 o'clock. So I will have to do the last 2 slides on Monday. Okay, thanks.